If you're questioning whether my process works in investing, I don't blame you. It's a very tough road when you see all these major hype companies over the last few years, and a lot of investors like Cathie Wood sit there and spurn all the Michael Burrys and Warren Buffetts of the world and say they're wrong. They don't understand innovation. I get that. It makes perfect sense. I was in your shoes 22 years ago during the dot-com bubble. Even though I had inklings of value in there, I thought it was different. I believed in buying companies that had a great growth story, and I didn't care about anything else. Can they grow a lot? Yes, then I should buy them. Well, fast forward 20 years, and many of the companies went to zero. And the ones that made it, most of them have not even seen the levels of what they were supposed to do back then. So where does that leave us today? What that leaves us today with is understanding process. I'm looking at the results of the last year and a half. Here's what I'm proud of. I'm proud that I called the ARK investments and all the Peloton, Palantirs, the Zoom videos, all these videos, and you can go watch our library of 1,700 videos in which a year and a half ago, I was saying avoid these stocks. Workhorse, all these companies that all collapsed, 80, 90% or more. I'm very proud of that. That's easier to show that I'm being right on because it's so quick. It's easier for stocks to fall. Now, have I had my stocks that I started buying and go down? Absolutely. And I get these comments all the time. On Instagram, somebody said to me, but Paul, you've had stocks fall, and I will continue to have stocks fall. The difference is, when my stocks fall, I reassess. And if my thesis is still the case, and I think it's an example of the market determining a price that doesn't make sense, I buy more. When Cathie Wood stocks fall, what does she do? She literally came out and said, Tesla, $4,000 stock. Go Google it. She literally sold Tesla stocks in droves after a while. If it's worth $4,000 a share and she still believes it's the future of cars, why would you do that? It makes no sense. What do? I look at every investment as the present value of all future cash flow. My goal is to buy a stock for 70 cents when I think it's worth $1 or some sort of discount. I call it the margin of safety. I don't call it that. Investors and value investors call it margin of safety. And guess what? Warren Buffett, the most well-known value investor of all time, a guy who's gotten over 20% returns a year for the last 60 years, a guy that if you gave him $100,000 60 years ago, you'd have hundreds and hundreds of millions, maybe even billions of dollars today from $100,000 investment. That guy gets ridiculed and said he's past his prime, he doesn't get it, and it happens in every bull market. Why? Because value investing does not buy into hype. So, my goal is that when all stocks are falling, I find the best quality stocks that are misunderstood. How are they misunderstood? Well, they might not be growing a ton. They might only be growing at 2 single-digit growth rates a year. Well, nobody wants those boring stocks. I do. Why? Because they're mispriced. Because when everybody else avoids them, they don't buy them, the stock doesn't rise. So the stock's prices stay low. Now, when all stocks sell off, guess what? They're going to sell off with it. But the goal there is they're probably the fastest to rebound and they probably don't fall as much. Why? Because they have the better quality balance sheets and the better quality cash flow and better multiple of cash flow. So when people start to realize, you've already seen it. This year, you already started to see, even Uber said, the market has shifted. We need to focus on cash flow now. That was their way of saying people aren't going to overpay for hype as much as before. And that's what I want us to do as value investors. If this process makes sense to you, and if you're new to this channel, I'm Paul. Like I said, I'm a value investor. I look at the quantitative aspects of a business as my first starting point looking at any business. If that makes sense, I go further. I then look at the quality of the business and the other qualitative aspects, like sometimes management. What are they doing with the cash? Are they doing the smart things with cash? Are they buying back shares at cheap levels? What are they doing to make the company stronger to survive? Because that's what really matters in investing. Can you buy a company at a cheap enough price? And as they survive, you can compound as they build their balance sheet up and make it a better company. You don't need 20% growth rate a year because guess what? That doesn't happen forever. Eventually, that story goes away. But the problem is most investors buy a 20% growth story and the prices they pay for them assume 50% growth forever. They just don't realize it yet because they haven't done the numbers. That's why we created our software. And our software includes the stock analyzer tool. And when people say to me, I don't get growth, what's the first line of the stock analyzer tool? Revenue growth. I understand growth. I just don't overpay for growth. That is the difference. And I'm okay with that. Being a value investor involves being right, being wrong all the time. When the stocks are going up like crazy and it doesn't make any sense to us, we're avoiding it. People say you don't get it. And when stocks are falling like crazy and we're buying stocks and they continue to go down, you don't get it. It happened recently with Intel. Geez, Paul, you really don't get it on Intel. Maybe I don't. I could very well be wrong on Intel. My goal is to have 30 or 40 businesses that have the same quantitative aspects as Intel that I can own. And there will be a chunk of them that I am wrong on and they do very poorly. But the vast majority probably will not do very poorly, and some might even outperform the ones that did poorly. But if I tell you what I probably will not happen, I probably won't have many 80 or 90% drops in a matter of 6 months on any stock. Is it possible still? Absolutely. But those will be very few and far between. And I will have them in my career. I'm only 41 years old. I'm going to be investing for the next 59 years of my life until I drop dead at the age of 100 at my desk on my birthday. I'm speaking that into existence. I will have losses, but my gains will far outweigh those losses. The hard part is when you own 10 stocks that are all hype and they all fall 70 or 80%, it's going to take you decades to recover from that. I saw a funny meme today on Instagram. And by the way, if you're on Instagram, do me a favor and follow me because I have a precious ego that needs to be followed at Paul Gabriel, RAIL. On Instagram, I saw a funny meme with this soccer team high-fiving and crying and so happy, confetti going off. And the caption below was, the year is 2053, and when you finally break even on your crypto investments. Like, that's what I look at. Look at crypto. Yes, crypto, I've been saying no to. I agree with Warren Buffett when he says, I wouldn't buy all the crypto in the world for $25. Why? Because we don't understand how it makes money. When thousands of crypto are coming up every year, new ones, and they don't differentiate each other other than technology, how do you do that? At least with currency, the differentiator is the government behind them. So my goal is to sit here and say, guys, for you, if it makes sense to you to buy $1 for 70 cents and just be patient, you found the right channel. If that doesn't make sense to you, I get it. I used to be in your boat. And maybe it'll work out for you, maybe it won't. I don't know. But for me, what works is I find the process that works for me and I invest that way. And I share that with people. And that's not going to appeal to everybody. And I'm okay with that. And if it doesn't appeal to you, I get it. We just have a different view of the world. But math is math. At the end of the day, math is math. And the thing I like about a stock analyzer tool is it allows me to look at a company like Tesla and say, for it to justify today's price, what needs to happen to the company? Well, and my calculations, it needs to be selling 20 million cars a year in the next 10 years to justify today's price. And it has to have really high margins. Is that probable? No. Is it possible? Of course it is. But if it's not probable, I'm the poker player at the table. If I have pocket aces and an ace right there showing, and there are 3 kings, I'm just going to lose some of those hands because somebody else will eventually have a king in there and will beat me or something like that, or a full house of some sort. But if I have pocket aces and I bet smart every single time, I will end up with more money in the long run. That is my goal with investing. I want to pick 30 or 40 good companies, my pocket aces, that a few of them will lose to some offshoot full house or whatever it's going to be. But overall, my pocket aces are going to win. That is my goal. So if this makes sense to you and you like the idea of margin of safety, you want to learn more, I want you to do 2 things for me. First off, watch our next video about margin of safety. And second, please subscribe to our channel. We do 3 or 4 videos a day. You will thoroughly enjoy it.